Hi, we're working on Taylor Company question where we have two scenarios for the same bond. In the first scenario, it's sold at $102,458,071. So we have 102,458.71, and it's the bond. The stated value on the bond is 13%, so it's sold at that to yield 12%. So we're going to do an amortization because for the sake of answering part B of the question. So first we start off with 102,458. That was on January 1st, 16. And in June, so it pays twice a year, in June and December. And so we're going to only do partial amortization. The payment, the cash that we're going to pay every 6 months will be for the stated rate. So it will be 13% multiplied by the face value of the bond, 100,000, and multiply by 6/12 because we're doing this every year. So this is this gives us a total of 6,500. So we have 6,500 here, 6,500 here. For the interest expense, we're going for the first one. So it's carrying value times the yield rate, 12%, multiplied by 6/12. So this is the formula, the last carrying value times the yield rate times 6/12, because it's every 12 months. For the first one, the carrying value is 102,458.71. When we multiply that, we're going to get 6,147.52. So that's where our number here is coming from, 6147.52. With that, we take this, subtract it from 6,500 to get the amortization for the premium. So the premium is the extra $2,458.71. So the difference between these two is $352.48. We'll take the amortization. So we're slowly or methodically decreasing this such that at the end of the amortization, if we completed this, the last number would be 100,000 at the date, and this will coincide with the date of that the bond matures. So we take this, subtract that from it, we end up with 102,106.23. And we repeat this again. So the next one, the carrying value, instead of 102, now we 102,458, now we have 102,106.23 as our latest carrying value. With this, our result of that computation is going to be 6126.37. So that goes here, 6126.37. We take this, subtract it from 6,500. We have $373.63. We take the 102,106.23, subtract that from it. Now we're down to 101,732.60. That completed. Now we can do our journal entries for this question. The first journal entry is to record the issuance of the bonds. So when we issue the bonds, we were given cash, a total of 102,458.71. And now we have a liability, bond payable. And the bond payable, the face value is 100,000. The rest of the difference, the 458.71 is our premium on bond payable. So 458 and 71 cents. Next, we are required to do the interest, the 2016 semi-annual interest payment and premium amortization. So we need to do the 2016 one. So we need to do the 2016, so June 30th, and then we'll do December 31st. So on June 30th, we have interest expense. So the interest expense for June 30th, we already completed it in the table, so this is pretty much easy. We're just picking that up. 6147.52. We have the amortization for the premium. We already calculated it. So premium on bond payable, $352.48, and the total cash that we paid out was $6,500. For December 31st, our interest expense, we already computed that, was $6,126. And the premium, that again is from the table since we already completed it. Premium on bond payable was $373.63, and the cash we paid out again in December, cash of $6,500. The other requirement was for the we also need to record. So we'll let's pause for a moment, and then we'll start on the effect on the alternative scenario where this was sold at $97,606 and 71 cents. So let's work on the alternative scenario where the bond is sold at 97. So it's sold at $97,606.71. So it's yielding 14%. So it's sold at a discount. So the cash payment for each period is still $6,500 because the bond has a stated rate of 13%. So similar to the prior scenario, it's still $6,500 for the payment. For the interest expense, we'll take the last carrying value, multiply that by 14% times half a year, times 6/12. So we get $6,833 and 17 cents. So just supporting calculation for that is 97,616.71, or the last carrying value. So the next one we'll use the next payment over times the yield rate, 14%, times 6/12. We take that, multiply by 14% times 6/12, we get this. We're going to subtract 6,500 from 6,833 to get the amortization of the discount, which will be $333.17. Next, this was sold at a discount of $200 and some amount on top. So the difference between 100,000 and the 97,616. Subtract the discount is there. We need to amortize it, meaning we're increasing the value, the book value of the bond. When we add this to that, we have $97,949.88. We'll repeat this again. So next we'll do 97,949.88 times 14% times 6/12, and we're going to get 6856.49. We take this, subtract 6,500 from it to get the discount amortization. So we have 3, 56, and 49. We take the last carrying value, add the amortization. Now we are up to 98, 306, 37. So with that complete, so we just need the first two. We don't need the rest of it to address the questions that we were given. So the first transaction was, of course, to record the sale of the bond. So we get cash, 97,616.71. We have a discount in this case because we sold it for less than its face value. So discount on bond payable is 2,383 and 29 cents, and the bond payable is for the entire stated face value of 100,000. Next, let's do the discount for June. So in June 30th, 16, we have interest expense. So we are getting this straight from the table, 6,833 and 17 cents. And we have amortization of discount on bond payable, the 333. And we have cash of 6,500. So that concludes June. Let's do December. So 12, 31, 16. We have interest expense, which we already computed here, 68.56. We have discount on bond payable, we already computed that. We have 356.49, and we do pay out cash. So this is being paid every 6 months. We are paying out $6,500, and put descriptions under your journal entry. So this is to record interest payment for December 31st, 2016. So with this part complete, you can compare the two to see the approach is similar. However, on one, if we have a discount, the carrying value keeps increasing, and then it will end up at 100,000. For the other scenario we had first, it was at a premium, so it is the carrying value is decreasing, and eventually it ends up at 100,000. So that concludes the requirements for this question.